previous lectures, we created 3 strategies. One of the comments we made was that we're not really managing risk in a very meaningful way, because all we're doing is we're splitting the positions equally among the forecast chips relative to the forecast value, and we are always having a unit leverage. So we're always betting 100% of our portfolio, and sometimes you want to bet more, and sometimes you want to bet less. And this is the concept of volatility. Well, to demonstrate that, I'm just going to run these 3 files. So I'm going to import save pickle, simulations.object, and this is df1, df2, df3. So let's get these 3 data frames and inspect that later. But for now, we're just going to run this code. And let us explain the concept of volatility as we're waiting for this 3 backtest run. Okay. So let's go over to our notepad, and we'll see. Now assume that we have a price chart. Okay. Okay, it's not what we want. Assume that we have a price chart, and it's something like this. Right. So this is the price of. Okay, prices don't look like that. No, but it's it might look something like this, and this is the price, and this is with respect to time, and maybe this is the price of Apple. But if you compute the relative difference, so if you compute price at time t and minus the price in the previous time period divided by the previous time period, then we have what is known as a return price. So the return is going to be very close to 0. Right? So this is the origin. This is t. This is 0, and very often we're going to have prices that are quite close to 0, but it's going to be scattered quite randomly around 0. So this is the return for different periods. Now, one of the interesting things is that prices, for example, this stock is, maybe this will be level 0.02, just negative 0.02. And maybe this stock is, say, Apple. But if you pick something that is smaller, like a small cap, or like a cultish stock, right? So this kind of stocks is going to be a lot more volatile. So there will be a lot. I mean, it will still be scattered around 0, but you're going to constantly get a lot of. You're going to get a greater bandwidth in terms of the possible return values. So actually, you want to, if you take the square of this, right? So return square, then it's going to look something like this, right? And in this case, it's going to look something like, there are significantly higher peaks. All of them have peaks once in a while, but some stocks are going to have a lot greater volatility. So this is said to be the standard deviation of the volatility of the stock. To say that something is more volatile means that the stock prices will tend to move up and down a lot more aggressively. Right. So that's the first thing to know. So different stocks have different volatility. Right. Different stocks have varying volatility. And the second thing to know about stocks prices is that high levels of volatility, right, are associated with higher levels of volatility around the data point. So, for example, if today there is a large positive move in the stock, then tomorrow there will also be a large move in the stock. We don't know whether it's going to be positive or negative, but large moves are associated with large moves. And this concept is said to be volatility clustering. Okay, so first point, different stocks have different volatility, and 2, volatility tends to cluster. So large movements are associated with large movements in the near future. So with these 2 different concepts, we can already do some form of risk management, right? So I suppose that I want to bet $100 in Apple, and I want to bet $100 in Tesla. And suppose that the volatility of Tesla is significantly larger than the volatility of. So okay. assume that the volatility of Tesla is larger than the volatility of Apple. Now, we can bet $100 in these two respective positions, but they are not representative of the same risk. Because even though I put $100 in Tesla, even though I put the same amount in both stocks, the one stock is bound to move around a lot more aggressively, which means that our bet in Tesla is actually more risky, right? Now, on the other hand, suppose we have this scenario where our forecast for AAPL is equal to 2.0, and our forecast for Tesla is equal to 1.0, which means we are twice more confident in Apple than we are in Tesla. Actually, let's flip it around. So suppose we are twice more confident in Tesla than we are in Apple. And suppose that the volatility of Apple is exactly half the volatility of Tesla, right? In order for us to have the same amount of risk, we can basically say that the volatility is equals to risk. As I said, we don't know whether it's going up or down. Well, if we knew whether it was going up or down, then that would solve the trading problem altogether, because we can just bet in the direction. But the problem is, we have suspicions that it will move a lot, except we don't know the direction. So we know that, okay, we can equate volatility to risk, and this is the same. Okay. So as you said, if we have the same dollar position, we are actually betting more in Tesla because this is more risky. So we're allocating more risk to Tesla if we know that this volatility is higher than Apple's volatility, and we put in the same dollar amount. So this concept should not be too difficult to understand. In the same way, we can say that if you're twice more confident in Tesla, but it's also twice more volatile, then we should bet the same amount actually. So because, okay, we bet, okay, assume that there is no forecast here, right? So assume that this forecast here doesn't exist. Then assuming equal amounts of confidence, half the dollar sizing in Tesla is the same risk as the full sizing in Apple. Okay, so this is our sizing. And now that we are, we want to put in our relative forecast. So if we multiply by the forecast, then we have the same dollar position sizing. So, okay. So this gives us the concept of being able to use volatility to size our positions relative to other assets in our portfolio. So I hope that makes sense. So that's the first point, okay? And the second point, so this is what the first point is saying. But this point would not be very helpful if we don't know the future volatility, right? Because we know that this stock is more risky, but we don't know exactly how much more risky it is. And this is where the second point comes in. If we can use our historical volatility, right? If we can use, say this is volatility and it goes up and down. If we can use our historical volatility, for example, we use 20-day period of historical volatility to predict the volatility in the next time period. If this is a reliable estimate of future volatility, then we can reliably estimate volatility. Okay, so what we need is information about future volatility, not volatility that is at a time period that is in the future. But because of volatility clustering, it turns out that information about historical volatility is a good approximation, can give us a good approximation of the future volatility. So a function of historical volatility can give us a good approximation to future volatility. And this is why the two concepts here are important, and we can use that. So we're going to implement exactly that, right? Okay, our program has finished running, so let's do this. TF1, TF2, TF3 equals to load pickle. Okay, and let's first of all plot some things. Okay, let's see PLT plot TF1.capital. We'll do a show. Okay, close. And then let's also plot the volatility. Let's plot the rolling historical volatility. So this is non-zero returns equals to okay, so this will extract the non-zero returns from the data frame, right? and then we'll take, in order to plot the volatility that go above, it takes another return, and it'll take the return time series, and then we'll standardize it to annualized volatility. So return r.standardized r. We'll plot the 25-day rolling volatility. 153. Regular plot. Looking close. So, okay. We'll explain what this code is doing. But let's just say plot for and non-zero return and let's see how that goes. Okay, so let's run this. Okay, so these are the 3 data frames, and this is the capital. And then this is the volatility, right, of the first strategy, followed by the volatility of the second strategy, and then the volatility of the third strategy in annualized terms. We'll explain why we do this later, but let's also plot annualized. So okay, so this is the annualized volatility. Okay, let me explain what I'm doing here. So remember that we computed inside our portfolio DF, there is one of the columns is set capital return. Okay, so this is capital return, and because we align our data frame to have every single day between start and end, there are bound to be holidays and weekends, so there'll be a lot of 0 rows. So what we're going to do is we're just going to extract this, and then we're going to filter out the 0 rows. So we're only going to get non-zero return values inside this list, and we're going to compute volatility from here. But the reason why so the volatility, as we said, is the standard deviation of returns, which is basically r minus the sample standard deviation will be, well, actually no, this will be, mathematically speaking, this will be this, right? So this is the mathematical standard deviation, but because we have sample, our estimate of the volatility will be taken like this. So something like that. Very nice. So this is our volatility estimates. Okay. So this is the true volatility, which is unknown, which is impossible to know. So we're computing the volatility of our strategy using this sample. And usually when we compute estimates from a sample, we'll put a hat on top. Okay. And the reason why we multiplied it by this number by square root of 253 is because, well, first, this is the number of trading days inside a year, and we're trading using daily data. So we can assume that, okay, every year the sample size is about 253. And, when you have a return, when you have a price, at any point in time, let's say at this point in time, if you just go a small step ahead, you can sort of predict that the price will be inside this range. But if you take a bigger step, you will also have to have a wider range of wider estimate to make sure that the price will safely be inside. And of course, if you go much further, you don't know how the price will evolve. So if you're doing predictions a lot further into the future, you're going to have to cast your estimate a lot wider. So obviously, normally when we talk about volatility, we talk about it in terms of annualized or yearly performance. So when I say that my annualized fall is 16%, usually I'm saying that every year I either make or lose 16%. And since our standard deviation is computed in terms of daily prices, and volatility grows as a square root of the time, if we want to convert our risk into annualized terms, we're going to have to multiply it by this factor. So basically what I'm saying is, let's say single return is equal to x, right? Let's say this is x, then I'm saying that on a daily basis, I will lose or gain about X percentage of my portfolio. And if I convert it to annual terms, every year I will lose or gain about this amount, which happens to be very close to 16x. So that is the conversion here. Okay. But of course, this is the volatility of our entire portfolio. What we want to look at is this code over here, which we are betting everything equally. But as we said, we want to bet in the number of units of the risk that is involved with a particular strategy. Right, so let's assume that we will take in a target volatility, right? So it's very hard to say, this year I want to make 20%. Like, okay, that is a reasonable risk, but it's very hard to confirm that you will make 20%, to make 20%. So we are specifying our goal in terms of the portfolio risk and not the expected gain from the portfolio. So let's take in a volatility target, right? So this is our target volatility for the entire portfolio. So portfolio vol equals to portfolio vol. Okay. Let's just do some more settings here. So let's fill in more statistics. So capital return and nominal return. Okay, so the P&L, let us start with 0, select 0, and 0. Okay. Now let's look at here. So we've already made our forecasts. Okay. Let's reference our VOR target. Okay. Our VOR target is the portfolio vol in percentage terms. But let's convert it to annualized volatility. And then let's further convert it to be in terms of dollars. Okay, so this is our volatility target in dollar terms. Sorry, this is annualized volatility, and this is the daily volatility. Because we're converting it back from annualized to daily units, and then this makes the volatility in terms of dollars. So that is our target. Okay. Then let's scale our forecast equals to by the number of chips that we have. So this is our scale forecast. And what do we want to set our position to be? Okay, so this is our forecast, and we want to set our position equals to the relative to the scaled forecast, and then multiplied by the volatility target. So here, the volatility target is for the entire portfolio, but because we scale our forecast to be relative to the instrument, this will be the volatility target for the instrument instead of the entire portfolio in dollar terms, and then we will divide it by the volatility of the instrument. We'll divide it by the volatility of the instrument, as well as the volatility, as well as the instrument price, right? So we'll explain what this code is doing in a minute. So scale forecast. So this is the volatility target for the whole portfolio. This is the volatility target scaled by the forecast for the instrument in dollar terms. And then this is the volatility of the instrument in dollar terms. And this would be our position sizing. So that should make complete sense, right? So, because this is the volatility target for the instrument, and this is the volatility realized by each instrument. So total number of positions should be the number of should just be this divided by this, and we can delete this altogether, which means we now need to implement this. So volatility computation, as I said, there are many ways to compute volatility, such as Garch models and or using exponential moving averages and things like that. We're just going to keep it very simple here and compute that using historical volatility. Okay. We're going to take this return, and then we will do rolling 30-day historical volatility, and then we just take a simple standard deviation sample statistic as the volatility estimate. So this is our instrument volatility. Okay, and we will put that here as return. Sorry, volatility. And we will also do which is for the empty ones, so 0. Okay, we will explain some of the code. It's very critical that we compute the volatility before we fill the returns. Before we compute the returns. So see that we are repeating this computation here, right? We already did this over here, but we're not going to use, if we do this and we put it over here, that would be wrong. In order to show you that, let me just bring that up again. Now, so the return statistic will be, remember that we our closing prices are, say, C1, C2, and then C3, C4, C5, C6. So inside here is a trading holiday, right? So when we forward fill, so this is, originally we have a neat data frame that just has this sequentially. Okay, this is our original data frame, and then we join this. So this is where the join operation occurred, and we say that we must compute the volatility at this stage before we join. And the reason is because, you know, if we already do a forward fill here, then you're going to have C1, C2, 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 and then C3, C4, 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 C5, C6. Then because we forward fill, and then if we compute the rolling volatility, say we compute a 5-day rolling volatility, then there will be 3 duplicates of this, and we will essentially be doing the volatility here will be C3 minus mean of C1, C2, C3, sorry, so C1, C2, 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 C3, standard deviation of C2, 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 C1, C3. And obviously this will make the computation of volatility very low. And this is problematic, right? Because, well, these are not real values. We filled these values, and this will throw off the computation of the sample statistic. So in our case, we want to compute it over here, have the correct volatility computation. So let's say this is volatility computations. And then we want to forward fill the volatility. So this is V3, V4, then V4, V4, V5. So our volatility statistics on missing days would be the most recent volatility instead of the volatility computed using forward fill data. And just one more detail. If you remember somewhere in our code, we did something like inside the position, we did something like some piece of code here, and then we did volatility multiplied by close. So this appears in the denominator. So what happens if the volatility goes to 0? Then the position will go to infinity. Now, in what scenarios can the volatility go to 0? We must be very careful, right? So suppose we're computing a volatility statistic, and we have C1, and then we have missing data. So this is not a number, and this is all missing, and then we have C2. Now, obviously, if we forward fill everything, if you compute the volatility of this, it will be 0. But there's another scenario where, suppose there's still data for the stock, but suppose we're presented with data for the stock. So we have C1, C2, C3, C4. So every day, the stock was actually on the exchange trading, and there is data for it, but the closed prices did not change. So this is exactly equal. Now, if you compute this, and let's say this is very small change, and let's say this is approximately equals to this, and everything else is the same. Now, when we do this, you can imagine that the standard deviation is going to be very, very low, and because I'm sorry, I think this can be removed. So this thing is a mistake. We're not computing the z-score, right? We just want to compute the standard deviation. Anyway, the standard deviation goes to 0, and this will make our position size go to infinity, which is of course very bad, because we want to. The whole point is that we're controlling our position sizing for volatility, position sizing as risk management. But if we do this, then we are basically screwing up our risk management, and we don't want that. So it will be a decent practice to set a minimum volatility level. So if the volatility level is below, say, a certain threshold, then we set it to this minimum threshold. Otherwise, we will use the original volatility. Okay. Now, we can actually run this, but you should know that the portfolio volatility will not actually change, because all you're doing, okay, let's go ahead and run the first strategy. So let's do this, and let's see what we get from there. So we change it in the util file, so we change it in the main alpha class, so our strategy one should also be affected, and should now be implementing this risk management technique. And what we're saying is that different values of risk for individual positions should be scaled differently, and different position sizes should be taken for different levels of volatility. Now, we can see our portfolio is no longer taking the same amount of leverage, right? Sometimes it is taking lesser than a unit position, and sometimes it's betting more than the amount of capital. Sometimes it's borrowing money to bet larger. Okay, this is great, and let's just stop that for now. This is what I call as instrument level volatility targeting.